Hello, everyone, and a stressful Tuesday morning here. Can you not hear me? Yeah, okay. Hopefully you can all hear me. A stressful morning this morning due to the power cut, which has destroyed quite a few of my workspaces. Charts that won't load. I've got all sorts of things. I've got to rebuild the whole thing. I've rebuilt one or two while Anna was talking. Oil is one that survived, but in a curious sort of way, you might think, well, Forex and oil, all the rest of it. First of all, oil is an important commodity within the Forex market through the prism of relational analysis, obviously. But what it also shows is that when you apply the indicators, when you apply volume price methodology, it really doesn't matter what the chart is because the principles are exactly the same. I've got a multiple array. I've got 15-second, 1 minute, 3 minutes strung across the top, and 5, 10, and over to the daily on the right-hand side. But really, just what I wanted to highlight was several aspects of this. First of all, this is a 5-minute chart for oil, as I say, September contract. And what do you see? What jumps off the screen at you? Well, clearly, this huge spike in volume. We're in congestion. Volatility is triggered. What do we expect with volatility? We had it here as well to a minor level, into congestion. We've got one to the upside now. There's two things you can guarantee with volatility. First of all, that the market makers are actually participating in this. They are participating in this particular move. And secondly, almost invariably, it's a trap move of some description, either to draw you into congestion or to reverse the market, because what this is premised on is the fear of missing out, FOMO, which we all have to deal with as traders. You see something moving very rapidly, you want to jump in, make some quick profits, and you get trapped on the other side of the market. And you either get trapped in congestion, which is emotional pressure from the market makers, or alternatively, it's a full-blown reversal. And that's what we had here. And the curious thing is that traders many Forex traders seem to be unaware of the fact that, this is oil, this is trading on a 24-hour market. The same is true of indices, trading on a 24-hour market. And yet, as we come into the European session here, we get this spike. And the same is true of London. This is not Forex, this is oil, but the same principles apply, where you get an uplift in activity, you get it through 7 o'clock into 8 o'clock London time here, and off we go. And then it's really the application of VPA. You've got falling price, you've got nice spreads. We've gone through this area, what was potential support. You could see it here acting as support. This is a price-based support. This is on the accumulation distribution indicator, but it's the same principles as apply on the MT4, MT5 with support and resistance indicator. In other words, it's purely based on price. And it's an important plank of volume price analysis, because it's not just about the analysis of volume and price, but also about bringing all the other aspects of chart behavior, of price patterns, of support and resistance. And this is a nice example. Went through here. This was very strong, as you can appreciate. The individual lines on their own, the thicker they are, the stronger they are. That's how the accumulation distribution indicator works. It's like Popeye in the cartoon, where he eats a lot of spinach and his muscles grow. Well, it's the same principle here, exactly the same. The greater the number of times these are tested, the stronger they become. I'm just keeping an eye on this price action, trying to push through here, because this is now significant as a resistance area, but at this point it was support. But we managed to get through there. But the important point is, when you've got clusters of these together, they become even stronger. So this was an important region. We plunged through there, rising volume, nice price waterfall. Yes, we had a volatility trigger. We didn't stop at that point, went straight on down, lots of volume. Then what did we see at the bottom? We start to see some buying coming into the market. We've got these sorts of candles. We've got more buying going on here. And also there's another reason that we're now moving into congestion phase, because we've now come down to the volume point of control, which is sitting down at this region at 42.05, 42.04. And now we're starting to see the reversal take place. We've had the trend monitor, now we're coming out the other side, and off we go up to the upside. If we break through this region here, then we've got a nice platform of support in place. So if it closes at 42.24.25, then we've got a nice platform of support in place for a move to the upside, and away and off we go. And really, that's all it's about. And this workspace is a multiple time frame. So you're seeing everything. You've got a volatility trigger here on 15. What are you expecting on a 15-second chart? Well, it's exactly the same principles. Intercongestion, now we're starting to move away. And you've got a bit of weakness here. We're over onto the 1 minute. Just pop that up full size. What have we got here? Decent volume. We saw it here, initial weakness here. Then we've got some weakness coming in here. 2 equal volume bars, high volume, weakness, more weakness, expecting congestion. What do we see? Volume falling away on the sell side, so we're not expecting that market to collapse out of sight. Then we get a little test here, low volume, that's fine. Dip down, low volume, and on up we go up to the next level. And then what have we got above us in terms of volume acting as resistance? Very lightweight, because volume can be used in exactly the same way as price. In other words, where you have thick regions, dense regions of volume, as you always do at the volume point of control, that's the heaviest region. As that volume falls away, expect the price to move through there pretty rapidly. As the price moves up through here, you've got very light volume through this region, so 26 to 36 should be a relatively easy journey for this particular market to push through. So, the principles are exactly the same. It doesn't really matter what you're looking at. You can see the trend monitor here, transition to blue on 1, transition to blue on 3, starting to transition on 5, hasn't transitioned on 10 yet. It is still flip-flopping around. Oil has been sat at this level for weeks and weeks and weeks. It's in a very, very tight, congested range. I'll show you it if I just move the chat box out the way. It's a perfect example of waiting, the patience game. At some point, this market is going to break. You've got a very strong platform in here below. We're trading around the volume point of control. We've got very light volume above. What this needs is, and this is Wyckoff's law, this is Wyckoff's second law of cause and effect. In other words, the longer a period of congestion extends, then the greater will be the extent of the subsequent trend. It's a little bit like the analogy I've used many times is of winding a clockwork toy or a clock mechanism, an old spring-based mechanism. You wind it ever tighter. You are basically storing energy in that spring as you wind it, and then that energy is converted into a breakaway and the extensive trend the more you put in. So if you wind it up to its maximum, it is waiting just for that breakaway, and that is part and parcel of breakaway trading. It's not for everyone because it requires patience. That's something none of us are very good at. But if you're a patient sort of person, then that principle, again, that's on a daily chart. It could be on a 1 minute chart. The principles are exactly the same. Let's just I'll go and see what workspaces I have got available. Let's just have a quick look on the currency strength. I had to kill off one of these because it just wasn't loading, and I can't even load bare charts at the moment because it's destroyed my cache, this power outage. Just see where we are. This is on 2 minute, this is 5 minute, 10 minutes, so we're starting to see across the time horizons a lot of Swiss franc buying, really strong Swiss franc buying, this green line. So some really nice trends developing on that throughout this session over the last hour or so. So something like the Swiss franc against the Aussie would have been a really nice trade down to the bottom, up to the top. Now the Aussie is starting to buy quite strongly. So without even looking at the charts, I could tell you where to go and look. If you want to pick up a trend, you'd be looking at something like the Aussie dollar, because the Aussie is rising very strongly, the dollar is selling off very strongly. It's also starting to curl over here. It doesn't have to get up to this overbought and down to the oversold regions. It's starting to roll over the dollar. The Aussie is starting to kick higher. So we've had a nice trend already. If you're down on the 2 minute or 1 minute as a scalping trader, a lot of that trend's already gone. You've had the cross. We're starting to get up towards the overbought. The dollar's still got some way to go. We haven't actually had a cross yet on the 5 minute. So if you wanted to jump into that trade, that's fine. You're jumping on the trend that's underway, which means you can set your stop loss that much closer. But if you're now looking at something like the, let's say the New Zealand Swiss, the New Zealand down here, very oversold. The Swiss franc up at the top, very strongly overbought. If you're looking at that a reversal, and that's my personal preference, I always look to the extremes. I know a lot of you know that already, but we do have some new people in the room as well. It's about your tactical approach. Do you want to trade trends, or are you looking for reversals? And the payoff for reversals is obviously you get in early, so you get to take all of the trend or a great chunk of the trend before it actually gets underway, but the price you pay is a wider stop loss. If you're now jumping on this trend on the Aussie dollar, your stop loss can be much wider, much narrower rather, much tighter. It might be only a few pips, might be 3, 4, 5 pips if you're scalping. If you're trading this as a reversal, you probably have to put 10, 15, maybe more than that. But the payoff is much greater, and that's what it comes down to. A lot of trading is about the payoff, how much risk you're going to put on the table for how much reward. So that's developing nicely. So I've got that on the majors chart, which wasn't destroyed, the majors matrix. So let's head over there, see where we're going. There we are. So this is on, can't remember what this time frame is. Where are we? This is 5 minute. Okay, fine. So that's the Swiss franc up at the top. This is what we're seeing right now, right at the moment, which is here. Where's Aussie dollar? There we are. There we go. So this is what we're seeing right now. We're seeing this little trend develop. So, you know, I knew that without even looking at the chart. Not being clever, I'm just, that's the way to use the currency strength indicator. It is, as Anna said, it's the starting point to identify where to go and hunt. It's like a sonar on a fishing boat. You know, when they set out on a decent sized boat to go fishing, I'm talking about commercial fishing now, they will have a sonar, and what they're looking for are those shoals. They'll know certain areas, of course, just from experience, but what they're looking for are shoals, and that is what they use. And it's exactly the same principle with the CSI. It helps to guide you to those areas which are going to potentially deliver the best opportunities for you. Now, what the CSI doesn't tell you, of course, is it tells you where to go and look, and then you're on the chart and you're looking at, well, you know, what is happening? And clearly what's happening right now is that we are approaching the volume point of control here. This is on 5 minute, and you'd have this set up in multiples. So if you were going to take this on as an opportunity, not suggesting you would right now because of that single fact, we have reversed up back to the volume point of control. What do we expect to see at the volume point of control? We expect to see congestion building. Why? Two reasons. Firstly, because it is the volume point of control itself, in other words, the fulcrum of the market. And secondly, you've got the heaviest concentration of volume here. This volume spike here is always going to be at a maximum. The volume point of control is the fulcrum of the market. It's the seesaw. It's the point at which there's no divergence between bullish and bearish sentiment. In other words, they're equally weighted, if you like. So it's going to sit there until it starts to break away, and that breakaway will be on good volume. And then as you move away, you're looking at the low volume nodes. Am I going to move through here relatively easily? Well, yes, because the volume is falling away, so volume acting as resistance is going to be relatively less than in this level or in this level. And then if you break through this region, happy days, because there's very little volume above, and there's very little price there as well, so we get through there fairly easily. Now what you're seeing from a volume perspective, we've got weakness coming in. We've got a wick to the upside. Market's trying to rally. Lots of volume under that. So, you know, that's telling you loud and clear, this is not looking terribly strong at the moment. So we're expecting some weakness. We're also expecting congestion because we've got the volume point of control here, etc., etc. In terms of the reversal from a volume perspective, you can see it here. What you're looking for all the time is you're looking for those anomalous candles, that anomalous behavior between price and volume. And when you get something like this, if this market were going to carry on lower, then on that particular amount of volume, what you'd expect to see is more something like this or something like this, because from a comparative nature, in fact, these are identical. If you look at the volume here and the volume here, they are identical. So if that did that, why has that not done the same? And clearly there's some buying coming in there. We don't know how much buying, but certainly there is enough buying to get this market to pause. That's what you're doing the whole time. You're looking at the volume price relationship. Now, the other aspect of this particular chart array, if you like, is that what it also gives you, it gives you a clear perspective on the dollar. In other words, is the dollar being bought or sold universally across the dollar complex? And that's reflected in several different ways. What you expect to see, if that is the case, is you expect to see cable rising because the dollar is the counter currency, Aussie dollar rising, Euro dollar rising, dollar CAD going the other way, New Zealand dollar rising, dollar Swiss going the other way. So in other words, you should have 4 pairs going in the same direction. Trend monitor should be pretty much the same across all of them, which it's starting to change that in this down move. It was bearish, bearish, bearish. You'd expect to see this bullish and bullish, which is what we've got pretty much. Now it's starting to rotate a little bit. So you're looking at it through a completely different perspective. You're looking at it through the prism of the dollar and whether that buying or selling is universal across the particular complex. Yep, I will do. I'm going to pause there. I have got one or two other workspaces, but that's held up remarkably well.